In 1975, PepsiCo fired the first public shot in what would become known as the Cola Wars. Their weapon? A simple blind taste test called the Pepsi Challenge. Nearly 50 years later, this battle between two American business titans has evolved far beyond a taste test between two soft drinks. In part one of this two-part business case, we traced how Coca-Cola and PepsiCo grew from small pharmacies in the American South to become global powerhouses, each generating tens of billions in annual revenue. We saw how their intense rivalry pushed both companies to innovate, expand, and transform. But the real story isn't just about marketing campaigns and market share. It's about how these companies built business empires that have stood the test of time. In this episode, we're diving deep into the engine rooms of these corporate giants. We'll uncover how their distinctive business models have created two very different paths to success. While Coca-Cola has mastered the art of beverage dominance, PepsiCo has built a diverse empire spanning drinks and snacks. Both strategies work, but in fascinatingly different ways. Join us as we decode the business genius behind these enduring companies. We'll reveal how they've adapted their strategies for the modern era, explore their vision for the future, and answer the ultimate question. In the Cola Wars, can there really be more than one winner? So, let's recap a bit. A business model is a description of how a business creates, delivers, and captures value. A business model is made up of four interlocking elements: the value proposition, resources, processes, and profit formula and priorities that together help create and deliver value. In our first episode of the Cola Wars, we looked at the value propositions of Coca-Cola and PepsiCo. Let's now explore the other key elements of their business models and try to figure out how their profit formulas, priorities, and business structures help them succeed year after year. The profit formula of a business simply refers to its revenue streams and cost structure that enable that business to make profits. To understand a profit formula, we need to look at the product mix, profit margins, revenue streams, and cost structures of a business. This means understanding how a business operates, including their distribution channels, research and development efforts, and innovation, as well as marketing and branding. Let's begin our exploration with the product portfolios of Coca-Cola and PepsiCo. The Coca-Cola Company has built an empire of drinks, serving 5 beverage categories representing 200 master brands. There are $20 billion brands in Coca-Cola's product mix that enable it to be the global leader in soft drinks. Coca-Cola's brands include trademark Coca-Cola, which includes Coca-Cola Classic, Diet Coke, Coca-Cola Zero Sugar, and other variants that have Coca-Cola or Coke names associated with them. Sparkling flavors category includes all other carbonated soft drinks, such as Fanta, Sprite, Fresca, Schweppes, and Thumbs Up. Water, sports drinks, coffee, and tea is another growing category for Coca-Cola. Juice, value-added dairy, and plant-based beverages are also gaining traction, especially among the more health-conscious consumers. Then there's the emerging products category. At present, this includes 3 kinds of alcohol ready-to-drink beverages: hard seltzers like Topo Chico Hard Seltzer, hard alternatives like Lemon Dew, and pre-mixed cocktails like Jack Daniel's and Coca-Cola. Compared to the beverage-centric Coca-Cola, PepsiCo operates through 2 main segments: beverages and snacks and food. PepsiCo's diverse portfolio has several brands generating annual retail sales over $1 billion, including Quaker, Tropicana, Gatorade, Frito-Lay, and Pepsi-Cola. PepsiCo's beverages segment includes Pepsi, Gatorade, Tropicana, Mountain Dew, and Aquafina, among a host of other beverages. Its snacks and food segment is dominated by Frito-Lay snack brands including Lay's, Doritos, and Cheetos. Quaker foods, including Quaker Oats, make up the foods category. This balanced mix of beverages and foods makes PepsiCo resilient against market fluctuations and consumer trends, while its complete reliance on beverages makes Coca-Cola relatively more vulnerable, especially in a world of increasingly health-conscious consumers. Coca-Cola divides its global business operations into 6 key business segments: North America, Latin America, Europe, Middle East and Africa, Asia Pacific, Bottling Investment Group, BIG, and Global Ventures, GV. Coca-Cola's net operating revenue of $45.75 billion in 2023 came from selling 33.3 billion unit cases of products. Of this, $16 billion, or 36.6%, that is over one-third, came from the North American segment. It's interesting that in North America, Coca-Cola sells fewer drinks by volume but makes most of the revenue and profits. The American market continues to be the jewel in Coca-Cola's crown. In contrast, in all of its overseas markets, more unit sales do not translate to more revenues, even though some do have corresponding profit levels. Asia Pacific is the exception. In terms of beverage volumes sold, Coca-Cola sells a lot more outside of the US than it does in the US market. If you wonder which international markets are most important for Coca-Cola, approximately 30% of the drinks sold by volume go to 4 large markets outside the US: Mexico, China, Brazil, and India. Interestingly, in the rest of the world, other than the US and the largest 4 markets, actually absorbs 54% of the unit case volume of beverages that Coca-Cola sells. But the story for revenues and profits is very much different, as we saw earlier. Coca-Cola's ability to generate more revenues and profits in the US despite selling fewer unit volumes is tied to a combination of pricing strategies, its product mix, and market dynamics. In the US market, Coca-Cola focuses on premiumization, smaller package sizes, and functional beverages that help drive higher revenues and profits per each unit sold. Let's break down how this works. Coca-Cola uses a premium pricing strategy in selling products in the US. Its focus on higher margin items with smaller packages, such as 8-ounce bottles, enables Coca-Cola to command a higher price per ounce compared to larger packages. Innovative and functional beverages such as sparkling water and energy drinks are often priced at a premium, thus they contribute to revenue growth without needing higher sales volumes. Also, remember that these are growing product categories that support increasingly health-conscious consumer and lifestyle trends. In terms of the product mix, the US market has a higher proportion of value-added and premium products, including low-sugar options, flavored drinks, and functional beverages. They generate higher revenues for each unit sold compared to standard carbonated drinks. Coca-Cola also benefits from partnerships and licensing revenues that come from its growing portfolio of ready-to-drink products, such as coffees and teas. Brand loyalty and marketing investments are another reason for disproportionate revenues and profits earned in the US market. Coca-Cola's strong brand equity in the US helps the company sustain higher price levels. US consumers are willing and able to pay more for familiar and trusted brands. Effective marketing campaigns ensure that there is a consistent demand for its products, even at premium prices. In the US, Coca-Cola has well-established infrastructure and distribution systems that help the company optimize costs and improve profitability. In contrast, growing systems and structures in relatively new and expanding markets drive margins downwards. In regions like Asia, the Middle East, and Africa, Coca-Cola's primary focus is on growing unit case volumes to capture market share to meet the demands of expanding populations and rising middle-class consumers. In such markets, Coca-Cola prioritizes affordability. It often sells larger, multi-serve packages at lower prices per unit to appeal to cost-conscious consumers. Lower pricing strategies enable it to be more competitive within local economic conditions and in the presence of strong local brands. Affordability and accessibility helps drive sales for Coca-Cola, leading to higher volumes but lower profit margins compared to the US. The product mix in these regions leans more heavily toward core carbonated soft drinks, which have lower margins. Coca-Cola also focuses on products like juices and water, which generally have lower margins but help drive volume growth. Investment in market penetration is another reason for lower margins and profits outside the US. Coca-Cola invests significantly in marketing, infrastructure, and developing partnerships in emerging markets. These activities help it build brand presence and expand distribution networks, but tend to typically reduce short-term profitability. Coca-Cola knows that these efforts are critical for long-term growth in these regions. To sum up, Coca-Cola makes more profits with fewer volumes in the US because of its focus on premiumization, smaller package sizes, and functional beverages, which drive higher revenues and profits. In emerging markets, it prioritizes volume growth through affordable pricing and larger package sizes. The combined result is relatively lower revenue per unit, but higher overall sales volumes. These strategic priorities and differences reflect Coca-Cola's adaptability to diverse and evolving consumer preferences, changing economic conditions, and competitive landscapes. How much does Coca-Cola depend on sparkling or carbonated soft drinks? A lot, it seems. In 2023, sparkling soft drinks represented 69% of Coca-Cola's worldwide sales volumes, while non-carbonated drinks accounted for the rest. Trademark Coca-Cola accounts for approximately half of the unit case volume of the company worldwide. In the US, 61% of sales by volume came from sparkling soft drinks, including trademark Coca-Cola, which made up 42% of US unit case volume. The conclusion from all this is that most of Coca-Cola's revenues and profits at present depend on soft drinks, despite its many and continuing efforts to diversify the product portfolio. PepsiCo has structured its global business according to a divisional structure designed to operate with a local focus on the consumer. The 7 divisions of PepsiCo include 3 North American divisions and 4 geographic divisions. The North American divisions are divided along products, while the geographic regions handle both food and beverages. Each division works independently and may offer licensed products from other brands. PepsiCo's key markets and divisions are Frito-Lay North America, FLNA, Quaker Foods North America, QFNA, PepsiCo Beverages North America, PBNA, Latin America, LATAM, Europe, Africa, Middle East and South Asia, or AMESA, and Asia Pacific, Australia, New Zealand and China, APAC. The North American divisions collectively contributed to 61% of PepsiCo's net revenues of $91 billion for 2023. International divisions made up the rest of the 39%, contributing $36 billion. The US market alone accounted for 57% of PepsiCo's 2023 net revenues. PepsiCo Beverages North America, Frito-Lay North America, and the geographic segment of Europe are the largest contributors to PepsiCo's revenue, accounting for over 70% of net revenues for 2023. However, the North American and European markets are mature markets. Therefore, the biggest growth drivers for PepsiCo are the rest of the geographic divisions, including Latin America. Developed markets contributed 69% of PepsiCo's reported net revenue in 2023, while developing and emerging markets made up the balance of 31%. Of PepsiCo's 2023 global net revenues of $91 billion, 59% came from food products. Net revenues from beverages of 41% added up to $37.31 billion. This is almost 82% of Coca-Cola's total net revenues of $45.75 billion. Yet despite the importance of snacks and foods in its global portfolio, Pepsi and other soft drinks dominate the total product mix of PepsiCo even when you only consider the US market. This is another indication that cola wars will continue, even without changed contexts. Coca-Cola's reliance on soft drinks and its beverage-centric portfolio results in lower revenue diversification. Trademark Coca-Cola, all Coca-Cola variants together, accounts for approximately half of the worldwide sales volume of the company. This makes Coca-Cola vulnerable to health-conscious consumer trends. To overcome this weakness and to diversify product margins, Coca-Cola seeks to expand into healthier beverage options, lower sugar formulas, and premium products. But the limitations of affordability are slowing the growth of these products in the global markets. PepsiCo derives its revenue from a more diversified portfolio, including beverages, snacks, and convenience foods. The snack division of Frito-Lay provides stable and higher margin revenues to PepsiCo, helping offset the slower growth in beverages. The company balances growth in beverages with snack innovation by leveraging cross-category synergies to increase profitability. Cross-category synergies come from selling snacks and beverages as complementary items to consumers. So, who's the winner on diversification? It's PepsiCo. The cost structure of a business has a direct impact on its ability to make profits. That's why the cost structure is a vital element of any company's business model. In this case, Coca-Cola has a business cost structure that is certainly worthy of looking into in detail. Coca-Cola sells beverages. We already looked at their product mix and how different geographic markets contribute to Coca-Cola's revenue and profits. But there's more to the story than appears on the surface. Coca-Cola's key activities are production of beverage concentrate and beverages, bottling, licensing, marketing, advertising, product promotions, and distribution. Did you catch that? That secret, an open secret so to say, is beverage concentrate. Although we think the company just makes and sells drinks, the Coca-Cola Company operates two lines of business. One is concentrate operations, and the other finished product operations. You know the latter, PepsiCo does it too. So do most companies competing in the beverage business. But the revenue stream from concentrates and the structure that makes it all possible has a significant impact on Coca-Cola's enviable profit margins, currently at 23% of revenue. Here's how this works. With concentrate operations, Coca-Cola sells beverage concentrates or syrups made by the company to its bottling partners. These partners are independent contractors, not agents, and their relationships with Coca-Cola are neither legal partnerships nor joint ventures. Bottlers combine concentrates from Coca-Cola with still or sparkling water, sweeteners, and other additives to make finished products. These drinks are packaged in authorized containers, which can be cans, refillable and non-refillable glass or plastic bottles, all bearing the relevant trademarks from Coca-Cola. These drinks, or finished products, are then sold to retailers, wholesalers, or other bottlers so that consumers around the world can enjoy them. In the company's lingo, the Coca-Cola Company and its bottling partners are collectively known as the Coca-Cola system. This system reduces the capital expenditure and operational risks for the company. This means that the company does not have to build manufacturing facilities and warehouses or maintain them. Coca-Cola also doesn't need to employ any people to do the work needed to get products onto the market, nor does it have to bear the costs of insurance and other expenses or even pay taxes in the local markets. The Coca-Cola system gives the Coca-Cola Company significant control over corporate assets even without owning them. Because bottling partners do most of the manufacturing and distribution of finished goods, Coca-Cola's cost structure is asset light. It's also light on manufacturing and distribution costs, as well as operational risks. Due to this structure, selling concentrates is highly profitable for Coca-Cola. This becomes clear when you look at the relative sizes of the two segments, both in terms of revenues and worldwide sales volumes. Concentrates account for 58% of 2023 net operating revenues, while the direct sales of finished products account for 42%. But in terms of unit case volumes, 83% comes from concentrate operations. Although Coca-Cola has many bottling partners, the largest 5 accounted for 42% of the company's total worldwide unit case volume. On the other hand, the finished product operations segment of Coca-Cola makes and sells sparkling soft drinks and a variety of other drinks through retailers, distributors, and wholesalers. Coca-Cola's finished product sales generate higher net operating revenues but lower gross profit margins compared to their concentrate operations. To put it another way, the Coca-Cola Company sells a whole lot more drinks in concentrate form than they sell directly as finished products, and earns more from them than they do from making finished products themselves. That's the biggest secret behind its lucrative 23% profit margin. Over the past decade, Coca-Cola has consistently managed to make a higher profit margin each year compared to PepsiCo, with the exception of 2017. Since 2018, Coca-Cola has consistently outperformed PepsiCo with double the margins or more. One key reason is its Coca-Cola system business structure. Coca-Cola's strategic, asset-light, overhead-light, risk-light model relies on its bottling partners to make and distribute most of its products. In return, Coca-Cola focuses heavily on marketing and brand building. These account for a significant portion of its total costs. To sum up, Coca-Cola's enviable profit formula is made up of high-margin, concentrate sales with limited manufacturing costs compared with significant investment in brand building. In contrast to Coca-Cola, PepsiCo operates an integrated business model more commonly seen in other companies. Pepsi handles more of its own manufacturing and distribution of snacks and beverages. This model naturally involves a higher fixed cost base compared to Coca-Cola's asset-light system. While this business model means increased operational complexity, it helps PepsiCo to capture more of the value chain and to control costs more effectively. It also enables PepsiCo to adapt products to suit the preferences of their regional markets. To sum up, PepsiCo's profit formula is made up of high-margin snacks combined with lower-margin beverages, balanced through economies of scale in both production and distribution. Product innovations and the flexibility to adapt products to suit local market preferences are also part of the profit formula. So, which company wins on business structure and profit margins? It's definitely Coca-Cola. Research and development efforts and the resulting innovation has significant impacts on the profit formula of any business. Now, let's look at how Coca-Cola and PepsiCo compare. Coca-Cola focuses its innovation efforts on expanding the beverage portfolio with new flavors, healthier options, and premium products. Even then, its R&D spending is relatively lower compared to PepsiCo's. This is also a reflection of Coca-Cola's narrower focus, which is limited to beverages. Coca-Cola continues to change its product portfolio to meet evolving consumer expectations, offering more options with less added sugar and more drinks with nutritional benefits. In 2023 alone, Coca-Cola launched 250 reduced and no added sugar products. Around 68% of Coca-Cola's beverage portfolio had less than 100 calories per 12-ounce serving. Approximately 30% of products by volume sold in 2023 were low or no calorie variants. Instead of sugar, Coca-Cola uses low and no calorie sweeteners that are safe according to global food safety authorities, like the US Food and Drug Administration, FDA. The company is also offering more small packaging choices. In 2023, 46% of Coca-Cola's sparkling soft drink brands were sold in packages of 8.5 ounces or less. As an early adopter of the Consumer Brands Association-led Smart Label initiative, Coca-Cola gives nutrition information on labels and access to product facts with QR codes on the labels. Here are some examples of the innovations that the company made. Coca-Cola Spiced hit shelves in February 2024 in two varieties, regular and zero sugar. Although product development normally takes about 12 months at Coca-Cola, this was done in 7 weeks, according to Shakir Moin, Chief of Marketing for North America. We're disrupting our ways of working. The mindset is we're a 137-year-old startup focused on bolder, faster, fewer innovations that delight consumers and create growth for the company. Ready-to-drink alcohol is a key beverage category that Coca-Cola wants to conquer. Like we mentioned before, its emerging products division is working on 3 types of alcohol ready-to-drink beverages: hard seltzers, hard alternatives, and pre-mixed cocktails. Lemon Dew, a hard alternative launched in 2018, was Coca-Cola's first ready-to-drink alcohol beverage. Topo Chico Hard Seltzer hit the markets in March 2021, reaching a national ranking of number 4 in the hard seltzer category and getting a 4.4 share in Oklahoma and a 3.6 share in Chicago soon after. In March 2023, Coca-Cola launched Jack Daniel's and Coca-Cola, a ready-to-drink version of the popular cocktail. These products demonstrate Coca-Cola's flexibility to cater to changing consumer tastes and evolving preferences and lifestyles. It's also proof that Coca-Cola is trying to grow its non-soft drink portfolio. On the other hand, PepsiCo invests more heavily in research and development compared to Coca-Cola to develop both beverage and snack innovations as befitting its broader product mix. It seeks leadership in health-conscious and sustainable products across multiple categories. For example, PepsiCo Positive, or Pep Plus, is a strategic end-to-end transformation drive towards sustainability, with industry-leading 2030 goals. Of its three pillars, positive agriculture, positive value chain, and positive choices, the third is about leveraging their brands to inspire positive choices among consumers. Positive Choices is about transforming Pepsi's portfolio of products by diversifying ingredients to include those with more nutritional benefits, reducing added sugars, salt, and saturated fat content. By the end of 2023, PepsiCo had transformed 56% of beverages to meet its self-imposed sugar reduction targets, 68% of convenient foods to meet sodium reduction targets, and 75% of convenient foods to meet saturated fat reduction targets. With the name Propel Immune Support, PepsiCo launched a variant enhanced with vitamins, electrolytes, and antioxidants under its Propel brand of flavored waters and powder mixes. The product, though developed before the COVID-19 pandemic, was launched in October 2020 at a time when consumers were seeking hydration drinks with additional health and wellness benefits. So which company wins on innovation and R&D? In terms of R&D expenses, PepsiCo leads by a wider margin. However, in terms of innovation, it's difficult to say which company wins. According to Brand Finance, a leading brand valuation consultancy, Coca-Cola and Pepsi were number 1 and number 2, respectively, in the top 10 most valuable non-alcoholic drinks brands in 2024. In the ranking, Coca-Cola was valued at $35 billion, while Pepsi was valued at $20.2 billion. How did the two brands perform worldwide? Global 500 2024 report of BrandDirectory.com included Coca-Cola as number 47 among the most valuable and strongest global brands. Pepsi was number 95 in the ranking. The Coca-Cola Company invests heavily in global marketing campaigns to maintain its position as a lifestyle brand. It prioritizes emotional connection and brand equity, with a primary focus on its iconic flagship brand and associated beverages. We can say these brand-building efforts and investments have paid handsome dividends, because Coca-Cola continues to be the top global brand in soft drinks. If we just compare the Coca-Cola brand with Pepsi-Cola, Coca-Cola certainly has bigger brand recognition and bigger market share, both in the US and globally. Coca-Cola was America's favorite soft drink brand in 2023, while Diet Coke also made the list of top 5 soft drinks, in the number 5 spot. PepsiCo also invests heavily in marketing and focuses on dynamic marketing and promotional tie-ins with popular culture. The company has a long history of working with celebrities in sports, music, and entertainment to enhance its brand image. Pepsi has worked with sports superstars including Lionel Messi, David Beckham, Serena Williams, LeBron James, Shaquille O'Neal, Tom Brady, Usain Bolt, and Neymar Jr., to mention just a few. Similarly, the company has worked with music superstars including Michael Jackson, Beyoncé, Britney Spears, Madonna, The Weeknd, Nicki Minaj, and Dr. Dre. The Grammy-winning rapper Megan Thee Stallion is the face of Pepsi's 2024 Make Your Game Day Epic campaign. Movie stars and influencers including Dwayne "The Rock" Johnson, Cindy Crawford, Kylie Jenner, Cardi B, and Steve Carell have also worked with Pepsi in advertising campaigns. These celebrity partnerships help Pepsi to leverage their influence to resonate with global audiences. Such collaborations often coincide with major events like the Super Bowl, the World Cup, and other culturally significant occasions. All of these efforts and campaigns help position Pepsi as a vibrant and youth-oriented brand. PepsiCo also leverages its portfolio to reach diverse customer segments, such as sports fans via Gatorade and young consumers via Pepsi. However, in the US market, in 2023, Pepsi marginally lost its long-held second-favorite soft drink brand position to Dr. Pepper. Here's how we can sum up the profit formulas and priorities of these two companies' business models. Coca-Cola relies on its asset-light Coca-Cola system and the beverage-focused business model to generate high margins through concentrate sales. Its priorities are brand building, expanding the beverage portfolio, and maintaining market leadership in non-alcoholic ready-to-drink (NARTD) beverages. Coca-Cola is also aiming to conquer the alcoholic ready-to-drink market with new products. PepsiCo balances its vertically integrated business model with a diversified product mix, which enables innovations across both beverages and snacks. Its priorities include leveraging synergies between product categories, driving operational efficiencies, and capturing emerging trends in health and sustainability. So, who has a better business model? It's obvious that both Coca-Cola and PepsiCo have pretty solid business models. Both companies have been growing their revenues and profits for years. If they didn't, would they have been included in the Fortune 500 rankings for the past 70 years since the rankings began? Going forward, PepsiCo's diversified and integrated model offers greater stability and growth opportunities, while Coca-Cola excels in beverage-focused branding and global reach. Coca-Cola relies on single-category dominance, while PepsiCo relies on multi-category innovation and resilience. So, we can conclude that both companies have winning business models that let them succeed in their own unique way. Now, to the important question, which company is more successful? As always, the answer is far from clear, so let's look at some objective metrics. You can measure the success of a company in many ways. We'll be looking at revenue, profitability, and dividends. Based on its 2023 results, PepsiCo ranked 44th on the 2024 Fortune 500 list of America's largest corporations with $91.47 billion in revenues. Coca-Cola ranked 95 on the Fortune 500 list with revenues of $45.754 billion. As you can see here, Pepsi's revenues are roughly double that of Coca-Cola's. Both companies are also among the world's largest companies. In the 2024 Fortune Global 500 list, PepsiCo ranked 123rd in the world, while Coca-Cola ranked at 332nd based on their 2023 revenues. So, the clear winner on revenue is PepsiCo. It's a far different story when you consider profits, or net income and profitability. With just half of Pepsi's revenues, Coca-Cola made a net income of $10.714 billion for 2023 compared to PepsiCo's $9.074 billion. As a result, Coca-Cola's profit percentage works out to 23.42% in 2023, while PepsiCo ended with 9.92%. Based on the complete full year's audited results available from 2023, the clear winner in terms of both profits and profitability is Coca-Cola. Dividend investors seek the predictability of dividend payouts and high yields in a company. Coca-Cola and Pepsi are both good dividend stocks and predictable dividend payers. Both companies have consistently paid and increased their dividends for over 50 years. Their stellar records in dividend growth over those years have earned them the prestigious title of Dividend Kings. Dividend yield is how much an investor gets back by way of dividends compared to the market value of their stock. Coca-Cola and PepsiCo have both been high-yield dividend payers. Coca-Cola's dividend yield is over 3%, while Pepsi's is just below that. If you want a comparison, both companies' yields are more than double the average yield for the S&P 500. But remember that dividend yields depend on the price of a stock, and stock prices may vary for reasons beyond the company's control. They do not always reflect the intrinsic value of a stock. As such, they present an opportunity for value investors. The dividend payout ratio is the proportion of earnings or net income that is paid to shareholders as dividends. This is fully within the control of a company. Coca-Cola and PepsiCo have similar dividend payout ratios, with Coca-Cola standing at 77% and PepsiCo at 75%. In other words, both companies distribute approximately 3/4 of their net income to shareholders. If you are an investor, you may want to find out how $10,000 invested in Coca-Cola and PepsiCo performed over the years. Here's what $10,000 invested in Coca-Cola and PepsiCo stocks 10 years ago, 5 years ago, and 1 year ago would be valued at now. Please note that the valuations were taken on January 2nd, 2025 at the time of creating this video. Whether you invested a decade ago, 5 years ago, or more recently, there wouldn't have been much of a difference whether you invested in Coca-Cola or PepsiCo. There is no clear winner here on that account. Although there are many other metrics to measure the success of a business, including employee and sustainability metrics, we have not explored those aspects in this video. That brings this episode of Cola Wars to an end. As you saw in this video, the Cola Wars are far from over. They're still being played out in the global arena in a modern, expanded, and more sophisticated form. We hope these Cola Wars videos helped you learn how the Coca-Cola Company and PepsiCo have become legendary global businesses while facing severe competition from each other for the share of consumer wallets and minds. They can teach us many useful lessons about growing market reach, market share, and product portfolios in today's world. How they are investing and leveraging research, development, and innovation to become more competitive and resilient is worth pondering. As they continue to adapt their product offerings to market forces and consumer trends, they are behaving like century-old startups. Both Coca-Cola and PepsiCo are admirable firms that can serve as great models for much younger, smaller, and growing firms. Thank you for watching. If you enjoyed this video, please subscribe to the Boardroom Breakdown YouTube channel and ring the bell to stay informed of our future business case videos. Remember to like, comment, and share. It helps a lot.